Picture a retiree at a kitchen table late at night. Bills on one side, a home they've spent decades paying for on the other. And in the middle, a question that keeps getting louder. How do I turn what I own into the cash I need to live? That question is reshaping lending right now. And it's why today we're talking about reverse mortgages, shifting mortgage rates, a few surprise economic signals, and even what your sleep schedule has to do with living longer.
It's a big mix today, but it's all connected by one theme: uncertainty. People are trying to find stability wherever they can, through home equity, through refinancing strategies, through picking the right bank, and apparently through going to bed at the same time every night.
Let's start with the headline inside the reverse mortgage world, because it's one of those wait, that happened moments. For the first time ever, private reverse mortgages, sometimes called proprietary reverse mortgages, have surpassed the government insured version, the HECKUM program, when you measure total dollar volume. That's huge. And it's not just a nerdy industry milestone, it tells you where demand is going. Private products typically have different rules, different loan limits, and different ways lenders can design them. When private dollars overtake the government program, it's a sign the market is hunting for flexibility. And it's also a sign of pressure, because at the same time we're seeing new counseling data that's pretty sobering. About 20% of people seeking reverse mortgage counseling are running a monthly budget deficit. Not tight, not watching spending, an actual deficit. That's the part that changes the tone of the whole conversation. A reverse mortgage is often discussed like a strategy move, but for a lot of households, it's becoming a rescue line. When 1 in 5 people showing up for counseling is already short every month, that's a retirement security gap, not a preference. And here's the twist. It's not just reverse mortgages. The broader use your home equity for cash flow idea is exploding because traditional options aren't reliably available. A lot of seniors look at a HELOC first, a home equity line of credit, but nearly half of HELOC applicants have been getting rejected.
Right, so what happens when the obvious door doesn't open? People start knocking on other doors. And lenders, especially the ones who are paying attention, are shifting their pitch. Less, here's a loan product, and more, let's solve the cash flow problem in front of you. That might sound like marketing, but it's also a survival response to what borrowers are facing. Let's zoom out to the rate environment, because it's basically the weather system that everything else is living under. Mortgage rates have been wobbling a bit. The average 30-year fixed recently landed around 6.38%, and the 15-year is around 5.75%.
And if you're thinking, that's still high, you're not wrong. But what's interesting is how quickly the conversation shifts when rates hover in this range for a while. People stop expecting a rescue drop and start asking, what's my best move if this is just the world now? One of the moves getting dusted off is the adjustable rate mortgage. ARMs have been called the forgotten stepchild of home loans, but they're getting another look because initial rates can be lower, with a very big asterisk. ARMs can work if you understand the risk and you have a plan. They can also backfire if you treat the opening rate like it's permanent. It's a little like buying a cheap airplane ticket and pretending luggage fees aren't real.
Meanwhile, the Federal Reserve has been holding its benchmark interest rate steady around the mid-3% range because inflation is still running a bit hotter than they'd like. The result? Mortgage rates haven't had a reason to fall dramatically, and they've been hanging around that 6.3 to 6.4 neighborhood.
And yet, despite all this, home building gave a surprise signal. New single-family housing starts beat expectations recently, more than 1 million starts, though permits for future projects dipped a bit. So builders built, but they're slightly less confident about what comes next. That's the story of 2026 in a sentence. Action now, caution later. And in the middle of all of this, people are still trying to answer a very practical question. Who do I trust with my money? That's why rankings like bank rates, best banks, and credit unions lists get so much attention. They're built from reviews of tons of institutions and piles of data. But what people really want is reassurance. Pick a solid place, and you'll be okay. It's uncomfortable, but it matters. Because when we talk about the housing market, it's easy to pretend everyone is experiencing the same system. They're not. The rules may be written the same today, but the starting lines were not. And for households that are feeling squeezed by debt right now, debt consolidation and relief services are getting a lot of attention too.
Whether it's that company or another option, the bigger point is this. People are trying to renegotiate the terms of their lives. They're refinancing futures, not just loans.
Okay, quick turn, but stay with me. Because the next piece is about something you do every single day, and it might be more powerful than we give it credit for: sleep. Researchers have been finding that cutting down on irregular sleep patterns, so not bouncing your bedtime around, could be associated with a lower risk of mortality, which sounds almost too simple. Not easy, necessarily, but simple. A consistent sleep routine is being treated like a serious long-term health advantage, not just good hygiene. And if you're the kind of person who sleeps through alarms like it's an Olympic sport, the market has noticed. There are new heavy-duty alarm options being talked about this year, some with extra loud alerts, and some with bed-shaking features that basically refuse to be ignored. That's both hilarious and, honestly, relatable. Before we wrap, I want to touch two lighter but telling stories about how people are processing the future. One is this comparison analysts have been making. Looking back to the 1920s to think about the AI boom, the idea is that we could be entering a roaring decade of growth, followed by the risk of a sharp crash, just with more software and fewer flapper dresses. The point isn't that history repeats perfectly. It's that fast innovation can bring euphoria, and euphoria can make people forget risk. That's a useful warning whether you're investing, building a business, or just trying not to make a panic decision with your home.
And then there's this absolutely modern headline. An AI simulation tried to predict a Kentucky Derby winner 2 years early and picked an underdog instead of the favorite. So yes, we've apparently created a way to argue about horse racing outcomes before the horses are even on the track.
It's funny, but it also captures the vibe. We're using models and rankings and forecasts to reduce uncertainty. About money, about health, about markets, about everything. Sometimes those tools help. Sometimes they give us the illusion of control.
So let's land this plane. If you're listening and you're feeling that kitchen table pressure we started with, here's the core takeaway from today's swirl of stories. 1. Home equity is becoming a central tool for retirement cash flow, especially as other options like HELOCs get harder to secure. 2. The reverse mortgage market is changing fast, with private loans now taking a bigger role by dollar volume. 3. Rates are still elevated, so strategies like ARMs are back in the conversation, but they require real caution. And 4, the future is noisy, so steady habits like consistent sleep might be one of the simplest ways to win.
And if there's a theme, it's this. The market is shifting, but so are people. Borrowers are adapting, lenders are adapting, builders are adapting, even our alarm clocks are adapting. Next time, we'll keep pulling apart what's changing and what you can do with it. Until then, take care of your cash flow, protect your downside, and if you can, pick a bedtime and stick to it. Please like, subscribe, and join us at I Am Health and Money. Life has its ups and downs, but you're not alone. From 10 to 110, we're in this together, right here, right now. We love ya.